Welcome to the Manning Up on Real Estate podcast. This is the podcast where we will have real talk on what is happening in the local market of Greater Vancouver. Here we'll discuss the news, strategies, and interviews to help you man up on your real estate career. I'm your host, Cameron Manning. All right, everyone, welcome back to the Manning Up on Real Estate podcast. I'm glad you're back here joining us for another awesome interview. Today, I'm being joined by mortgage broker extraordinaire, Kyle Green. Kyle, welcome to the show.
Hey, thanks, Cam.
Yeah, you're absolutely welcome. So just before we dive in here, for those of you guys who don't know Kyle, Kyle's a mortgage broker. He's based out of Vancouver, and lately in the last few years, he's been reaching the top 20 brokers across Canada. I believe last year you were ranked number 18. Is that correct?
Yeah, 2017 I was ranked number 18, and I grew 20% last year, so I'm hoping that I'm even higher this year.
That's excellent. So, Kyle, you have a specialty working with investors, but it didn't always start that way. So why don't we kind of go back a little bit so people can get to know who Kyle Green is, get to know who you are, and how you got started in the industry?
Yeah, sure. I was working for a local credit union and wasn't a huge fan of the credit or the unionized environment, so I ended up looking into other positions. A friend of mine, her parents were mortgage brokers, and so they introduced me, and I don't think they really expected much out of the rebellious daughter introducing a friend who was 19 years old to join the company. But I hit it off with the owner, and the rest was history. Initially, when I first started, we did primarily just your basic residential file, and of course we did some investors here and there. But at the time, I got introduced to Aussie Duroc through my old boss, and next thing I know, I'm attending his monthly meetings, monthly sessions, and learning all about investing in real estate, and kind of clicked for me that might be my ticket personally to leave the rat race at some point. And it started working out that I became the guy at REAG at Aussie Duroc's monthly functions, starting to do public speaking for his group, and now flash forward 12 years, and now one of the top investment brokers in Canada.
Now let's go back to that moment of meeting Aussie Duroc and getting a chance to become his kind of go-to speaker. There was a bit of a happenstance that happened there too. It wasn't just a progression. It was kind of almost you were thrown in the deep end there. Can you tell us that story?
Yeah, well, I think the story you're digging for here, Cam, is the one where I went to. So I'd done one trade show already with Aussie. The second trade show I was doing with him, probably about 700 attendees. He came to me in the morning and said, "Hey, Kyle, the other mortgage broker who's supposed to speak isn't here." So I'm 20 or 21 at the time, I think, and he's asking me to get up on stage at 1:30, and I have no material, I have nothing. So I look in, I peek my head into the room, I see a swarm of people. I'm like, holy cow. But Aussie and I decided at lunch hour, we quickly just rifled through a quick Q&A. And we did the presentation. I had a swath of people come up to me at the podium to ask questions, and people literally following me back to my booth to talk mortgages. And from that point onwards, I told Aussie, "Hey, the butterflies are gone. I'm doing this every time." So that's it.
That's awesome. So it was a real dive in the deep end kind of moment, because you were kind of thrust into that scenario, which really kind of solidified your relationship with the Aussie Duroc as well as the REAG crew there.
Yeah, exactly.
That's
It was fun.
And so you've really carved out a very particular niche, just like our team, working predominantly with investment real estate. Now, obviously, you do the regular buy and sell, refinances, things like that. But tell us a little bit about what it is you do with investors, how you work with investors to kind of not just buy one property and help them get that one mortgage and move on, but kind of establish a game plan for future growth and building a portfolio.
Yeah, it's really important to understand what the client's intentions are long term. So if somebody approaches us and says that they'd like to buy one rental property, that would result in one type of game plan. Whereas somebody that says, "Hey, I'd like to buy 5 or 10 rental properties in the next 2 years," very different structure, very different game plan. Conversations that start coming up here are, should you be buying in a company name or a personal name? How much leverage are you going to be able to obtain, and how are we going to get that leverage? Looking at being able to to ensure that I would say as your portfolio grows, especially if you're trying to get a maximum leverage here, interest rates are not as important. So looking at trying to make sure that maybe saving 0.1 or 0.2% on the interest rate would be more relevant for an investor who is just going to buy one rental property and be done with it. But somebody who wants to buy 5 or 6, the last thing you want to be told is, oh, because we set up the portfolio in the beginning to save you 0.1 or 0.2% on all of your mortgages, now you're completely tapped out and now you can't buy that 6th property. It's going to make you way more money than the amount that you're saving on the interest cost. So we really talk about structure. We really try to work with our clients on structuring the game plan properly right from the get-go and make sure that we're building with the end in mind. If you want to own 10 properties, then let's make sure that even from property number 1, we structure that properly, because fixing a portfolio and redoing it later is very expensive and not ideal.
For sure. And I'm sure that you guys do a lot of that too, where you're working with investors who started building a portfolio, might have been going direct to banks or with other brokers who maybe don't think long term. So you probably have to do a lot of those coaching and fixes of the portfolio as well.
Oh, totally, all the time. I mean, it's not uncommon for us to be dealing with somebody who, as you said, was working with somebody that just didn't specialize in working with investors. You have to understand that only about 4 or 5% of residential real estate is purchased for investment purposes. So what are most brokers and bankers going to focus on? That 95, 96% of people that are not real estate investors. I hear it all the time where branch managers look at a file and say, oh, I've never dealt with a client that had more than 4 properties, and we've dealt with literally hundreds. So I think that's the challenge is if you haven't dealt with a client or you've only dealt with a few clients that have more than 4, 5, 10 rental properties, you don't really know what landmines you're going to step on before you've stepped on them. So those people end up learning from experience when it's already too late. And that's where we have that foresight to look at where are you heading and what things are you going to have to clean up so that by the time you get to property number 4, you're already set up in a way where you do qualify, as opposed to, oh, once you hit property number 4, oops, I just hit a wall. We need to now redo these 2 mortgages and redo this and redo that and now set you up properly to buy number 4. And that's what people are usually looking for on the advice side of things.
For sure. And it's not just necessarily the setting up the mortgage advice that you guys have been working on. I know for one of my clients, you helped them not just set up a plan to purchase the rental property, but you also found ways to save them in different tax scenarios using line of credits and other things like that. Do you want to kind of go, I think you remember that deal. Do you want to kind of talk a little bit about that one?
Yeah, it was a really simple example. I still use it today because it's easy to understand the concept. So one of the keys and one of the really cool things about investing in real estate is that whenever you borrow money to invest, the interest portion of the payments are tax deductible. So we had a client where she was getting an ICBC settlement, and she was taking that capital, and her intention when she came to me was to say, hey, Kyle, I'm going to buy a rental property, and they're going to use this ICBC settlement cash to use for down payment. Now, we're not an order taker, so most people would say, okay, great, here you go, here's your approval, and that would be it. Now, what we did is we took that and realized, so we took that cash, we said, well, if we redesign your residence mortgage, take that cash, pay down your personal mortgage, get a readvanceable product where you have a mortgage plus a line of credit attached to it. Now we can show the CRA a paper trail showing you've now borrowed the down payment for the new purchase. Now we can write off the down payment portion. So it ended up being about, I think her purchase was around $400,000, so about $80,000. Even, and her tax rate wasn't that high, but even saving $80,000, borrowing it at let's say 3% at the time, so $2,400 a year in interest, at about a 30% tax rate, she's saving about $750 to $800 per year in taxes, and that's a very small, minor example. But those are some of the things that we look at and try to figure out, okay, what is the best mortgage structure, but also we need to look at things holistically and look at what's the best thing from a tax perspective too. And we can't specifically give tax advice, so we can always point somebody in the right direction and say, hey, talk to your accountant about doing this, make sure it works, and then we'll execute.
Yeah, absolutely. I do remember that deal quite vividly, and I remember when at first she had just in her mind was this is how it was going to be, and through the conversations, all of a sudden things started morphing, and she was just like, "Oh my god, for her, $750 a year was a huge tax savings for her. It might not be to some of you listeners, but for that person, it made a sense because she still got the property, she's getting cash flow quite regularly, and not only that, because we were able to buy that property back before the market really turned, she's now gained significantly. So she's got tax savings, growth on the cash flow, growth on the pay down of the equity, and huge appreciation. So it was a great move for her in the long run. And obviously, she wasn't looking at that appreciation at the time because we didn't know the market was going to go nuts. But for her, that 750 went a long way per year.
Yeah, she timed the market pretty well, didn't she?
Oh, absolutely, absolutely.
Yeah, that was
And
nice.
she was definitely buying in an area that no one else was looking at the time. So it was a smart move for sure.
Yeah.
Yeah, so I just wanted to jump into you mentioned something earlier, so I'm going to kind of take you back from something you mentioned at the beginning there, is interest rates. Now, a lot of people are very rate sensitive, and I feel like, and this is probably more relatable to when you got started in the industry, people were always looking for, well, what's the best rate you can give me? But I know through watching you and listening to you talk at different seminars and just the relationship we have with our clients, the rate conversation is now less important, and you hinted at it before, but tell us why it's not so much about what's the best rate, but I know you kind of talk about where's the best mold. Can you go into more detail on that?
Yeah, so I think a big part of this is how the industry has changed. So when I started in November 2006, when we would take a new call from somebody and they would ask, what's your best interest rate, I could answer that without even asking any questions. Because I could say, here's the best rate, and it applies to anything and everything. It doesn't matter if you're buying a rental, it doesn't matter what your down payment is, when you close, anything like that. Nowadays, it's incredibly difficult to even quote somebody a rate. But more importantly, we actually have to look at that client and figure out, well, number one, which box is this client going to fit into? So over the last 12 years, banks have become more and more rigid and tighter. There's been a lot more government policy. And particularly last year, there was a ton of government audits. The government was auditing the banks nonstop, trying to ensure that the banks are lending within their policy structure. So we used to find that kind of like strata bylaws and whatnot, a lot of these bylaws end up being things that are there that are never enforced, right? And I'm sure you've seen this, Cam, where you read strata documents with your clients and you're like, oh, geez, I wonder how often this is ever enforced. But it's one of those just
no dogs allowed and someone's walking with a Great Dane.
Yeah, exactly. And it's just there so that then if there's a problem with that dog, they have something they can point to and say, hey, look, you can't have dogs in here, right? But if the dog's not barking, nobody cares.
Exactly.
It's one of those things where for a long time the banks would say, well, this deal doesn't fit our box, but it makes sense. And so we're going to make the exception, and here's how we justify, and that was that. But now the government's going through and digging through all of those deals and looking at the bank and saying, hey, why'd you make an exception here? The bank says, oh, here's the explanation. And the government says, we don't care. You shouldn't be making exceptions to policy. If policy says this is what kind of lending you do, then this is what you should be sticking to. So the exceptions are going away, and it's becoming a lot more difficult to get deals done. But it is, as a mortgage broker, technically it's giving us a bit of an advantage, because in the past people could walk into the bank, and if you had a really good relationship and you're a pretty strong client, they would bend to fit your needs a little bit, because they want to keep you as a client and they want to make money. And one of the ways of making money is to lend out money. Nowadays, they're very rigid, and we have a much stronger client coming to us saying, I can't believe this, but my bank said no. And so our job now, first and foremost, is number one, where does the client fit? Which lender is the right fit? Then out of those options, what is the best fit for the client? So, which lenders have the best product, which lenders have the best rate. And to take that a step further, we also then start to apply the game plan that we've discussed with the client. So, for instance, some lenders have a cap on the number of properties you can own in total in the portfolio. And some lenders, the same lenders often, have a cap on the number of properties you can have with them. So let's say that there's not a very large number of lenders that will lend to clients that have over 5 properties. So a lot of these lenders also have a cap on how many mortgages you can have with them. So if, let's say, one bank does up to 10 properties in total but no more than 5 with them, and I think really there's only about 2 or 3 lenders that really go up to about 10 properties right now. So if you use one of those lenders for your first 5 and max out with them, you've just lost 33% of the overall marketplace for lenders that would lend to you when you have more than 5. If you used a different lender who may be 0.1 or 0.2% higher, or different lenders in the very beginning when there's a lot more options available when you're getting up to the 5 number, then you can still keep that extra option available to you to go from 5 to 10.
Right.
And those are just the little strategy things that we discuss with our clients to be able to build that portfolio.
Yeah, I mean it's key, especially with the current lending market, and especially since I've gotten into this business, about 9 years ago. It seems that everything continues to get tighter and tighter and tighter. Part of it's due because you get a run on the market such as Vancouver and Toronto had. So the governments at all levels start looking at ways that they can tighten it, because they look at 2 markets going crazy, but they look at it as Canada as a whole, and so they start making these changes. One of the biggest ones that we saw obviously was the stress test that was introduced. It was almost 2 years ago now, I believe, right?
Yep, 2 years.
So take us through what happened for buyers when the stress test was put into play, and what does it mean for buyers today trying to get approved, and what do they have to do to make sure that they can qualify?
Yeah, so the stress test essentially, what it did is it created a benchmark. So already there was a stress test for people putting less than 20% down and buying properties that were on a variable rate mortgage. So that came out actually 2011 when variable rates were very low, and the bank wanted to make sure that if you're getting a variable rate, you're not qualifying at that low interest rate. You're qualifying at where those rates may head at some point in the future.
So pre-planning.
Then they changed it, so they did it to all insured mortgages, and that was back in 2014 or 15, I think it was, where they said now it's not just variable, it's fixed and variable if you put less than 20% down. And then a year later, they came out with, no, you know what, now it's everything. And that stress test had a pretty big impact. So now, if you're qualifying for a mortgage, they take the either the rate plus 2%, or what's called the benchmark rate, which right now is 5.34%. So they're taking whichever is higher, of course, and now you have to qualify based on that rate. The impact it had with our clients is that it's decreased borrowing power by about 20%. So if you used to qualify for an $800,000 mortgage, you're probably qualifying for $600 to $640 nowadays.
And
it changed the metric.
That's a significant amount.
Oh, yeah. I mean, a lot of people are right on the bubble. I mean, if you're talking about $1 million qualification before the stress test, and now you're going down to the $800,000, that's a $200,000 drop.
That's the difference between buying a single-family home and having to downgrade your lifestyle to a townhouse or condo, depending where you live.
And sure enough, what do we see in the marketplace? We saw detached start to slip right away, and we continue to see condos and townhomes particularly appreciate quite aggressively after the stress test came out.
Absolutely, and that run went for quite some time too. Now, eventually, everything caught up, and we have noticed the slowdown from there. But, both myself, Kelly Fry, and my team, we've been kind of talking a lot that there's huge opportunities right now in the market because things have slowed down. And from the mortgage standpoint, where do you see the opportunities right now for buyers?
Yeah, from a mortgage perspective, or from, where to buy, what to buy?
Well, investment in general, like where are you seeing the opportunities, and how do people structure themselves to take advantage?
Yeah. I mean, number one, always before you start to run out there, is make sure that you actually have financing in place. Because if you don't have that financing, set up and set, you might be a little surprised when you start to look at places making the assumption that you will qualify, and then realizing, oh my gosh, I can't believe I don't qualify for this. So it's important to get pre-qualified, and also to make sure that you unlock any of the equity that you need to unlock. So if you are planning on using the equity in your home to qualify to do this and use for down payment, then you need to make sure you get that set up and arranged ahead of time. So it's always good to get that pre-planning out of the way. Then once you have that pre-planning done, that's where we would, start to, connect somebody with a realtor like yourselves and start to shop around. And if somebody asked me for my personal take on which markets I like the most, it's if you're looking at, I used to like downtown condos back when you could still before the Airbnb got shut down, because you could still do fully furnished rentals for medium term, like 4 or 6 months. But now I'm noticing there's a glut of fully furnished condos hitting the marketplace because Airbnb's been effectively shut down in the market. So I'm not a huge fan of that anymore. Mission and Chilliwack seem to have some decent cash flow. Hey Cam, like I'm noticing some places out in those markets that are cash flowing, positive or at least neutral with 20% down, which is good.
We're seeing that with the price drops too. I mean, we've got such a low vacancy right now. Rents are still on the rise, but the price drop has made the cash flow potential better in like Chilliwack and Mission and Abbotsford than we've seen probably in the last year and a half. So.
Yeah. So locally, I like those markets strictly from a cash flow perspective. If I'm going to expand my horizons a bit, then a few other markets that I like. I own some property up in Fort St. John and Dawson Creek. I'm still bullish on that market. I think with LNG and Site C, it's still moving slowly but in the right direction, and I think that will be a good market at least in a couple of years. Kelowna is an interesting market too, because it does have a very large impact from Albertans, and Alberta has not been a very good place to be living and working in the last few years. And so, when Albertans are making more money again, then you can expect that there'll be more of that money flooding into Kelowna again. It's a really good destination, and a lot of people forget that it's almost 50-50 in Kelowna. People from the Lower Mainland up in Kelowna, but also people from Alberta.
Right.
So I think that market is poised to have a bit of a correction. Similarly to Edmonton, I have my eyes on as well. Myself and one of my staff members actually bought a fourplex out in Edmonton a couple of months ago. So I like Edmonton. I think if it's not in the trough, it's very, very close to the bottoming out period. I like Vancouver Island. I like a couple markets there. I like Victoria, Nanaimo, and Langford particularly. And Sechelt is kind of an interesting one too, like the coast there, something like a vacation rental or something like that. But that's a different type of investment. So those would be the markets I think that I'm kind of keeping my eyes on right now.
For sure. Now, you mentioned Airbnb a couple times, especially at the beginning there. Not only is the like a lot of the cities kind of trying to shut down Airbnb. They're not, they're adding bylaws to a lot of condos that don't allow for short-term rentals. But there's a bit of an issue for qualifying if your plan is Airbnb as well, correct?
Yeah, so let's put it this way. Banks do not like to lend on properties that would be short-term rental accommodations. So vacation rentals, Airbnb, student housing even, because the tenants are quite transient. And let's be honest, 19-year-olds renting your place, a bunch of them. So, anything like that where there's a transient nature with the tenant and it's short term, those type of markets when things hit hard, it's usually the short term tenancies that see higher vacancy. Banks aren't a huge fan of those type of tenants. They don't take the same care that a long term tenant would of the unit, and so they're not a huge fan of that. If you already have it financed, or if you've purchased it and you get qualified and then you turn it into Airbnb later, the lender's probably not going to call the loan. But if you go to try to refinance later and it's evident that it's being rented out short term, you might have some challenges with getting the refinance approved.
Yeah, so even though there's a potential to make a lot more money doing an Airbnb strategy or something like that, they don't like it because it's not consistent, right? They like to see that solid lease.
Exactly.
Perfect. Okay, so there's a lot of things happening. Obviously, like I said, we mentioned our market has slowed down, and you and I had a quick conversation at the back of a room at an event we were at once, talking a little bit about what your thoughts are on interest rate. I mean, of course, nobody has a crystal ball, but we just had another rate hold, so they didn't increase the rates. But you had mentioned that you're seeing some changes in the bond yields, and you've got some ideas around that. Can you maybe explain how interest rates and bond yields relate and why there might be some more changes coming up?
Yep. So first, I'll give you just a bit of backstory for your listeners on why bonds and mortgage rates are so connected. So in general, what happens is most people follow the Bank of Canada announcements. So every roughly 6 weeks, the Bank of Canada meets and decides if they're going to move or change the overnight lending rate. And that's generally what the banks use to determine their prime rate. So if the Bank of Canada moves up a quarter point, then usually the banks move up. That would impact anybody who's in a variable rate mortgage. Now, fixed rate mortgages are not determined purely by the bank, a Bank of Canada. There are ways the Bank of Canada can influence bonds, which then influence fixed rates. But mortgage rates in Canada, the fixed rates anyways, are about 98% correlated with bond yields. The reason for that is that mortgages are typically lent out to people like you and me, bundled up, and then sold at the back door. And it's actually what caused the U.S. subprime crisis, because the mortgages were being bundled up and being sold as AAA mortgages when really they should have been rated as C or D or junk mortgages.
Right.
So it was interesting because what ended up happening is these large hedge funds kept wanting more and more of these, they called them CDOs, but they wanted essentially more of these securitized mortgage bundles, and they kept saying, hey, we want more of these. We just want a higher rate of return. So what would a bank do? They'd be told, hey, we want more of those mortgage bundles, so find more customers and find more people who want mortgages. So what would they do? They'd call back the people that they declined last month. It's kind of crazy. An interesting story I heard was, or a stat I should say, in the U.S. before the subprime crisis, the default rate, if the bank wasn't lending out enough money so that the default rate wasn't 4%, so that's the 4% of all of their customers were behind on their payments by 90 days or more. If their rate was below 4%, then they were told to lend out more money.
Wow.
In Canada, even in the height of the subprime crisis, we were always about 0.3 to 0.5% default rate. So it kind of gives you an idea. Like even in the worst of the times for Canada, we were still a tenth of what the U.S. was seeing. Mm-hmm. I digress. So right? With regards to bundles of mortgages being packaged up and sold, investors would buy either mortgage-backed securities, so bundles of mortgages, or they could buy bonds, and they're essentially a very similar asset class. They're both backed by debt, which is the most secure way of ensuring that you get your money back, because debt always gets paid before equity. And so it's a very secure way of funding mortgages, and for the banks, it's the most profitable way because then they get the mortgages off their own books. Mm-hmm. So the reason that they're tied together is because investors will buy either bonds or they'll buy mortgage-backed securities, and they're very similar. So what we've been seeing, and one of the reasons that we were talking in the back room there, Cam, was I was starting to see that the stock markets are slipping and bond yields were starting to slip. So usually if you see stock markets be in the red, you're usually going to see that the bond yields will fall, and that's because investors, if they're worried about the stock market dropping, they're going to start to go somewhere safer, and so they're going to start parking the money in bonds instead of parking it in equities. Mm-hmm. And so if you see the bond yields start to fall, then that usually means that fixed rates will fall. And sure enough, since I mentioned that I expected rates would be falling, we've seen a lot of banks drop their rates once or twice in the last 6 or 8 weeks.
Right. In fact, the big announcement recently was RBC recently dropped their fixed rate, correct?
Yeah, and it's funny because I don't know why RBC gets all the media attention. TD had already dropped the rates twice before RBC even dropped once.
Okay, so there you go.
Yeah, it's funny how that works. Whoever gets the biggest press hurricane, right? But yeah, a lot of the lenders had already dropped the rates before RBC even reacted.
Right. So, and that goes to talk a little bit about why, you really want a good mortgage broker who understands what's going on there. This is a conversation that we had prior to the new year coming up, that this is what you were seeing, and now sure enough, what you predicted is kind of coming true, right? We're seeing the drop of the interest rates in a lot of the banks. So if you've got a really on-the-ball broker, they're going to be able to kind of predict this and give you the advice you need to set up your portfolio properly. Maybe saying, okay, let's maybe wait, 30 days or whatever the case might be, see what that announcement is before we make the decision, right?
Totally, yeah. And what we're doing with a lot of our clients now is because there's been a gradual slipping in fixed rate mortgages, a lot of our clients that wanted a fixed rate mortgage, we're recommending that perhaps they consider a variable rate, because then they'll take variable, and maybe within a month or two, if the rates continue to slide, then they'll be able to lock into a lower fixed rate than what's available when they complete on their mortgage. So the strategy changes all the time, and you have to keep your eye on the market trends, and by doing so, we're able to best advise our clients on how to react with what's happening today.
Yeah, and that's key. I mean, whenever you're building a power team, you want people who can continue to advise you. It's not one-off transactions.
Yeah, exactly.
So you're still actively investing in yourself. You mentioned that you and a colleague of yours had just recently purchased a property in the Edmonton market,
Hmm.
and we talked a little bit about where you like. What's your game plan for your portfolio? What's kind of like what's the goal for Kyle Green right now?
My goal now really is to try and get into to more commercial. So commercial meaning multifamily buildings. So anything that's over 5 units is considered a commercial mortgage.
Hmm.
So when I reference commercial, it can be residential real estate, but done underneath the commercial financing banner. Um, Commercial financing is just done differently. I'm looking at doing things on a bigger scale. So instead of buying 1 to 4 units at a time, I'd like to be buying 12 or 20 units at a time.
Right.
There's also some things that you can do that are kind of interesting because in commercial, properties are purchased based on off of generally the income that they produce. And so what ends up happening is there's an interesting metric called a cap rate, capitalization rate. So a cap rate is a function of if you bought the building with cash after all of your expenses, so no mortgage, after your expenses, what would the cash flow be? So if you bought a property and it was a 5% cap rate, let's say it was $1 million purchase, 5% cap rate means that at the end of the year, after all of your expenses, you'd have 50 grand in your pocket. It'd be 5% of the purchase price in cash flow. The interesting part, if you reverse the equation and look at it from a different perspective, it means that if in a market where the cap rate is 5%, it means that somebody's willing to pay $20 to receive $1 in net operating income.
Right.
What that also means that you can reverse it and say, okay, if I increase the net operating income by $1, I've increased the value by 20 times that. I've increased it by $20.
Mm-hmm.
So now you look out and you try to find buildings that may be underperforming for whatever reason, where you can put in 100 grand or 200 grand of work into the property, but increase the value by 400, 600, $800,000. And there's a lot of people that are doing this on a much larger scale than what I'm looking at doing, but it's not easy to find these. You call them repositioning properties.
Mm-hmm.
They're not easy to find, but if you can find something where even just little tweaks, a new boiler, and all of a sudden, oh wow, the heating bill just dropped by X amount. Okay, that's a little tweak here.
Yeah.
Increasing the rents by $25 per unit. Okay, that's increasing our bottom line a little bit more. So all these little tiny things that you start to add up, all of a sudden result in really big results. And I'm more interested in doing that. I think it's a good use of my time. And commercial is very different world. It takes a little bit more expertise, and then most of our investors don't jump right from, early education and learning about real estate investing to, doing a 20-unit apartment building. Usually they buy a few residential properties first, get their feet wet, and then maybe transition into that. But I'm ready for the transition, and I'm actively looking at places. Randomly, I've run into a couple of potential deals that are trailer parks, and I'm in negotiations for too.
Nice.
Nothing's really coming through 100% on those, but they've kind of been hitting my desk, and I've been taking some action and doing some research and due diligence on them. So trailer park's an interesting one because in general, land appreciates and buildings depreciate. And in a trailer park, you usually just own the land with the concrete pads, and usually the owners, or the tenants, I should say, own their own trailers.
Yeah.
So the tough part about owning land is that usually buildings produce cash flow, not land.
Mm-hmm.
And, if you had an example I bring up is if you had a tenant and you'd say, hey, would you pay double the rent for the house next door that has double the yard? Usually the answer would be no. But if you had double the building, that means that you could rent it out to two different tenants now, paying about the same amount.
Mm-hmm.
So, extra building definitely results in more income in general, whereas extra land usually doesn't. So it's hard to find land that produces cash flow. But trailer parks is a great example of land that produces cash flow.
Because you are just renting the land out to other people.
Yeah.
Yeah, for sure. No, that's awesome. All right, so we're kind of getting towards the end here of our time, Kyle. But one thing I've been trying to do for those who are listening is to get a book recommendation from my guest speakers to see what kind of books you guys are reading and what you recommend for people to either get started, whether it's business, whether it's real estate, whatever the case might be. So with that in regards, what kind of books are you reading and what do you recommend to the listeners?
Wow. Well, I don't even know if I've told you this or not, but I'm actually writing a book, and it's finishing up. We're going to have a launch in early April, it looks like. We're just putting the finishing touches on it. So myself and another colleague just finished writing up Rockstar Real Estate Investing. So obviously that's a recommended book I have to throw out there. But okay. it still won't hold a candle to Stephen Covey's 7 Habits of Highly Effective People, which I just finished reading about a month ago. It's a great read. Rereading it again after probably a decade of reading it. 10 years ago, I guess is probably the last time I read it. You go through and you're like, oh man, there's so many terms here that people say all the time, and you're just rereading it. Like I used it today. Begin with the end in mind. It's such a silly, well not silly, but it's such a classic example of something that we should all be doing. But it really puts the book, puts everything into context. Sharpen the Saw is another one that, the little story of two people are trying to cut down a tree, and one guy is just casually doing it, but he takes every 30 minutes, he sits down and starts sharpening his saw, and he's wondering why the other guy who's just sawing furiously, keeps asking him, well, why are you sitting down? Like, why are you taking a break? And the guy says, well, I'm sharpening the saw. It's like, I don't have time to sharpen the saw. I'm too busy cutting the tree down. And sure enough, the guy that sharpens his saw cuts down the tree a lot faster. So a lot of examples where I thought that was really neat. So 7 Habits, if you haven't read it in a long time, I really suggest that you read that one.
Perfect. So 7 Habits of Highly Effective People, Stephen Covey. And again, book launch potentially coming out in April for the Rockstar Real Estate Investor. That's correct?
Yeah, Rockstar Real Estate Investing.
Real Estate Investing, perfect. And do you guys have any sort of link or anything like that for the website for that yet, or?
Just getting that going in the next week or so. So we'll have some more details. I'll make sure that I give you some details once I have the book launch and the website all hooked up here. We just finished writing the book, and we're just finishing bios and things like that literally yesterday. So awesome. It's getting really close to the end.
Can't wait to read it. All right, Kyle. So last thing, obviously, we want to make sure people can connect with you. What is the best medium that someone can connect with you, whether it's social media, website, phone number? What's the best way someone can reach you?
Yeah, website, because I don't have my phone number and an email. So that's www.greenmortgageteam.ca.
greenmortgageteam.ca. We're going to have this linked to all below in the show notes, and if he gets his website ready to go for the book, we'll make sure to include that on the show notes as well. Kyle, I do appreciate you coming on the podcast here for us today, Manning Up on Real Estate. Again, we use Kyle quite regularly. He really understands the manning up mentality of just getting out there and taking action in real estate. So he is my go-to broker to make sure that we get you guys set up, manning up, taking action in the market today. So again, Kyle, thank you so much for being on the podcast.
Yep, no worries.
And again, you're welcome. And for those of you guys who are listening, you want to get more information, don't forget you can go to www.youtube.com/Cameron Manning. We do post videos once every week or every 2 weeks there for you guys to get more content, more tips and tricks. And as well, if you want to engage with this podcast, there's 2 main ways you can do that. If you're listening on the Anchor app, you can actually call us on the Anchor app and leave me a voicemail. And depending on those voicemails coming in, we may be able to answer them with our guest speakers. Or you can use the hashtag ManningUpRE on both Twitter and Instagram. Ask us any questions that you guys have. Engage with us there, and we'll make sure we help you man up on your real estate career. Again, Kyle, thank you so much. That's it for us today, folks. We'll catch you on the next one.
Hey now, 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 hey now. What you gonna